Welcome to the channel. Today, we're diving into the Sensex's 800-point crash. It's been a wild ride, and everyone's scrambling for answers. We're talking 5 major factors that have brought the Sensex to its knees. So buckle up, because it's about to get real. Let's talk about the global economy. When the global economy sneezes, emerging markets like India catch a cold. Supply chain disruptions, soaring inflation, and rising interest rates are creating a perfect storm. The US Federal Reserve is signaling higher rates, slowing down growth, and making investors jittery. China is battling its own issues with a teetering property market and strict COVID policies. All this uncertainty is making even the bravest investors cautious. Foreign investors are pulling out their money, looking for safer havens. But India is resilient and has weathered storms before. This global slowdown is real and will have an impact. So buckle up, because it's going to be a bumpy ride. Now, let's talk about what's happening closer to home. The Indian financial landscape is undergoing significant changes, and it's causing quite a stir among investors. The Indian government has been rolling out new policies rapidly. These policies are aimed at boosting the economy and addressing various sectoral issues. While some of these changes might be beneficial in the long run, they've got investors feeling uneasy in the short term. The uncertainty surrounding these policies is palpable. For instance, the recent export duty on steel has spooked investors in the metal sector. This move was unexpected and has led to a lot of speculation. Additionally, the government's mixed signals on cryptocurrency have left investors confused. One moment, there's talk of regulation, and the next, there's talk of a ban. Investors crave stability and predictability. They want to know that their investments are safe and that the market conditions won't change overnight. Right now, with all these policy changes, that sense of certainty is in short supply. The constant flux is making it hard for investors to make informed decisions. It's like trying to build a house on shifting sand. Without a solid foundation, it's difficult to create something lasting and secure. Until there's more clarity on the policy front, expect investors to remain cautious. They're likely to hold back on making any major moves. They're going to be sitting on the sidelines, waiting to see how the chips fall. This wait-and-see approach is a direct result of the current uncertainty. So what's the takeaway here? Stay cautious and informed. Keep an eye on policy developments and be prepared to adapt your strategies as needed. Let's break it down sector by sector. Each industry is grappling with its own set of challenges, and the impact is widespread. First up, IT. The tech sector is facing serious headwinds from the global slowdown and rising interest rates. Companies are finding it difficult to maintain their growth trajectories. The strong rupee is also denting their export earnings. This currency strength makes Indian tech services more expensive for foreign clients. IT stocks are taking a beating, and investors are selling. The market sentiment is quite bearish, and confidence is low. Then there's banking. Rising interest rates and inflation are putting pressure on borrowers. This is leading to higher default risks. Loan growth is slowing down, worrying investors about bad loans. Banks are becoming more cautious in their lending practices. The auto sector is battling supply chain issues and inflation. These disruptions are causing delays in production and increasing costs. Demand is taking a nosedive, and people are postponing big-ticket purchases. The uncertainty in the economy is making consumers hesitant. Auto stocks are stuck in the slow lane, and it's uncertain when they'll pick up speed again. The outlook remains bleak for the foreseeable future. Each sector is feeling the heat differently. The challenges are unique, but the overall impact is a slowdown in growth and profitability. Stay tuned for more insights. We'll continue to monitor these developments and bring you the latest updates. Let's talk about foreign institutional investors, or FIIs. These are the big players in the financial world, often managing billions of dollars in assets. They have the power to influence markets significantly with their investment decisions. These big players can move markets with a single trade. Their actions can create ripples that affect not just individual stocks, but entire sectors, and even the broader economy. And guess what? The FIIs are heading for the exits. This mass exodus is causing a lot of concern among local investors and market analysts. They've been selling off their Indian holdings, putting massive downward pressure on the market. This sell-off is not just a minor blip, it's a significant trend that could have long-term implications. Why are they running scared? Global risk aversion is one reason. With uncertainties looming large, FIIs are becoming increasingly cautious. FIIs prefer to park their money in safe havens like US Treasuries. These are considered low-risk investments, especially in times of global financial instability. Indian markets have had a good run, and some argue they're expensive. High valuations make it tempting for investors to cash out and lock in their gains. When valuations get stretched, FIIs take profits off the table. This is a common strategy to ensure they don't lose out if the market takes a downturn, and there's the fear of missing out. When everyone else is selling, no one wants to be the last one holding the bag. This herd mentality can exacerbate market declines. Even if some FIIs believe in the long-term India story, they might sell now and ask questions later. This strategic selling allows them to reevaluate their portfolios and manage risks better. So keep an eye on FII movements. Their actions can provide valuable insights into market trends and potential future shifts. Understanding their behavior can help you make more informed investment decisions. Last but not least, let's talk about inflation. It's the silent killer that's been eating away at our purchasing power. Inflation is like kryptonite to stocks. When prices rise, companies face higher input costs, which they pass on to consumers. If consumers cut back on spending, corporate profits suffer. And when corporate profits go down, stock prices usually follow. Inflation also forces central banks to raise interest rates, making it more expensive for companies to borrow. Rising interest rates make bonds more attractive, diverting money away from the stock market. Inflation creates uncertainty and puts pressure on corporate profits. Until we see inflation under control, it's going to be a major headwind for the Sensex. So there you have it, folks, the 5 horsemen of the Sensex apocalypse. The market is facing serious challenges, and it's important to understand what's driving the downturn. But don't panic. Every market correction is a buying opportunity in disguise. Stay calm, stay informed, and don't make any rash decisions. Make sure you're subscribed to the channel and hit that notification bell for our next video on potential recovery strategies.